All right, we got Mish Snyder, Managing Director of Market Gauge. Let's get into it. Joel, take control.
How'd you like that introduction, Mish?
Fantastic. Thank you. I love the music. You got me going here.
All right.
All the bells and whistles. We're trying to compete with CNBC. We got to get the bells and whistles. We always had the content because we got people like Mish. But when you need the bells and whistles to compete
Absolutely.
with CNBC.
Absolutely. You need the infrastructure, something the airlines haven't figured out yet.
Yeah. Hope you don't have any flights planned for today. Well, 2023, I guess it's not off to like a real bad start, right? Kind of delayed January effect, but you put together your outlook for 2023. And Mitch, I sent that over to you. Can you bring it up? Because I like the picture of the rabbit on there. So give us a little clue here before you go into some of the details. A cute little rabbit there that you have on the cover. What's that going to be symbolic of?
Well, as you know, January 22nd is the Chinese New Year, and it's the year of the yin water rabbit. And so there's been a lot of speculation because rabbits are docile creatures that we're going to see a much more peaceful year. And in some essences, that could be true, maybe more on a social aspect. But in terms of the economic standpoint, the rabbit and the year of the yin water rabbit is not been seen since 1963, which is so interesting because 1963, we had the Kennedy assassination, we had the Beatles emerge, we had fashion completely change from the very conservative, staunch 50s into the start of the mod 60s. And the economy was not really doing all that well. We had a lot of volatility in the stock market, obviously, considering we led to an assassination and there was the aversion of the Cuban Missile Strike, and it was also the start of the Vietnam War. So if we look now at and say, well, if just looking at it from a pure, and of course, people would think this is kind of woo-woo, but from a pure astrological situation, I like to look at the Chinese New Year's every year and the animals and the elements because I always say, 2 billion people, they all feel collectively the same way that it can move things. And so the prediction this year is for still more trouble in the stock market because water energy is not good. But on the same side of the coin, there are certain areas that can do very, very well this year. And they're looking at things like beauty, and certainly some of those stocks like Estee Lauder and Ulta and Coty have done well. Music, we'll see what happens here with some of the music type of stocks like Spotify made a nice move over the last few days. Banks could possibly do well, and we're seeing JP Morgan obviously earnings doing really well. So, metals are something, and so essentially I'm taking this information with a little bit of a grain of salt. I more had fun with the metaphors. Right, going down the rabbit hole. But yeah, it's interesting. It's something I have followed. This guy Raymond Lowe, who is a very famous Chinese astrologer. He's an older gentleman now. I've been following him for years, and he's been pretty good in terms of his analysis and what he sees in his own way of doing the charts for the New Year's.
Well, so far, I mean, if you're talking, we've been talking about some of the Chinese stocks, Baba on the rebound, K-Web, that's moved up, totally different looking charts. But you're going to talk about some other ways to grow your wealth here in 2023. So you gave us that information. What other top trends or themes are you looking at?
Well, for me, and I heard you talk about this a little bit before I came on, is I'm not buying this inflation is over thing. The three themes of my whole outlook is A, expect chaos. And when I say chaos, I mean geopolitics. Yeah, maybe Ukraine and Russian war subsides, but in case people haven't noticed, there have been little coup attempts around the world, even with Brazil over the weekend and in Peru. Even Germany had one last year. And there's just more social unrest emerging as a result of populism and anti-globalism. All these things that have been put into place are one factor that we have to keep in our heads, North Korea being another one. And so I think, and then even in this country, there's been a lot of social unrest sort of under the radar. So I think that those things can be chaotic potentially going forward. I think obviously weather is already chaotic. I don't see any reason with La Nina for that to end anytime soon. And that could create havoc on energy and food prices. And then I also think that we're trying to fit, I say like a square peg into a round hole in terms of how we're looking at everything. Our definitions, right? Recession. Well, are we really in a recession when we have an unemployment number of 3.5%? Housing. Well, it's crashing from the peak, but does that mean that it's going to go into like a 2008 tailspin? No, there's still high demand. There's still shortages. And a 5 to 7 to 8% interest rate is something that we had for many years. It's actually kind of typical until we went into the crazy accommodative place where we went to our rates down to 3% for a mortgage. So I think that this is going to be a very interesting year. I don't see a major crash. Of course, there's a potential, but I see more of a trading range. And I'm really, really, really hot on the metals right now. Industrial metals, but precious metals.
I love gold, someone would say.
Yeah.
What about the gold stocks? What do you think about that move?
Well, I'm certainly not surprised. We've been long in and out of the gold for a long time now, and now we've just been in the gold with a steady core position since September of last year. Our blended models are long GDX and SLV, a couple of the gold stocks, and, just pure play GLD. So I listened to all this talk about the stocks and the earnings and the this and the that. And I'm like, if you just keep your eye on the ball of the metals and then keep your eye on, we love to talk about sugar as an indication of what's going to happen with food prices, even though we've seen things come down a little bit. And you keep your eye on energy and oil and coal, more than natural gas, that seems to be done. I think you're going to see all of this be still the top places to be in terms of your money, and have fun with the stocks, but be very agile as you're talking about with this January effect.
So let's talk about the retail investor, right? If you just go back over the last couple years, the environments that we had, 2021, pretty good years, 22, if you didn't sell, it was a rough year. And I know we have people of different ages, but just talk about like the long-term investing for the retail investor and what opportunities there are in 2023.
Well, for one, I think and hope that the retail investor has gotten a little bit of a clue about money management and risk management. And if that's the case, then obviously we're going to see these sort of trading ranges in this chop where the market starts to sell off when it looks like it's about to break out, and vice versa when it looks like it's about to break down, because there are retail investors that have gotten smarter and that are taking advantage of these sort of extremes in RSIs, if you will. In terms of the retail investor, for people who have portfolios in IRAs, in other type of retirement accounts, 401s, they've taken a big hit. They've taken 20, 30, 40% hits. And they have been told all along to buy the dip and that things are at value and inflation has peaked and the Fed's going to pivot. And they're coming into this year buying again. That's what we're seeing with no volatility, which is interesting to me, very interesting to me as a natural contrarian. So I think that if you are in your 30s or 40s and you've taken that big hit in retirement accounts and you want to put money into it and you can afford to wait 5 to 10 years before you start to see returns, fine. But if you're an older person and you didn't do something more conservative last year, I think you may be encouraged on how the year start and then get very disappointed as this year continues, when the realization is central banks don't really have control over the situation.
All right, now I want to come in here. Of course, we've been focusing often last year on monetary policy, but what about fiscal policy? What do we have there to be looking for in investments?
Well, first of all, thank you. It looks like you actually read my report because I cover all of this. So thank you so much, guys, for supporting me that way. Government spending, and not just in the United States, is an issue globally right now. When I say an issue, these sovereigns have absolutely no choice but to spend money and throw money at their economies to keep them afloat. And a lot of them have had hawkish talk and have completely pivoted, like Japan, classic example. If you recall, at the end of last year, they started tightening and they've completely changed on that. China's done more easing as well. And even the ECB is talking about, yeah, we're going to raise rates. And now they're saying, okay, well, maybe not so much. So it's really going to be a matter of what's happening, what the governments have to do to make up for the banks. And here in the United States, we are spending a lot of money with more money spending on the table. And people have gotten used to some type of stimulus that has gone on since before COVID. Now we're talking again about the student loans. And this is not to be political or even to be judgmental. It's just another fact that with anti-globalization, it puts countries in a situation where they have to spend more money to support and shore up their own economies in a situation where we still have supply chain energy problems, and now obviously still the potential of food problems, as we're seeing with sugar going up again. That's all inflationary, and that is not good ultimately for equities.
All right. Now, always we think about, what do we go after first? It's been usually the bonds that bottom first. So is it time for bonds, Mish?
Well, this is the most interesting part of the market to me right now, because long bonds have already bottomed. They started bottoming them in December. So you get the 20-plus year long bonds. And I think they were trading up before the market. I haven't looked in the last few minutes. But it's showing stress. Some people would say if the long bonds continue to go up, and what that means is yields fall, TLTs rise, that's a sign of recession coming. Other people say it's a sign just of the strain in the market. If we look at the inversion, people said, oh, that's a definite recession. There's your square peg round hole. That didn't happen. But if you look at the junk bonds, that's the thing that is fascinating me the most, because they have rallied tremendously, which means bond traders are coming in buying high yield, high debt companies, which is not something you would think people would do in a risky environment. And that's why, regardless of what my macro theme is here, as I've put together, with things possibly getting very hairy, particularly in the inflation, I still have to look at the micro and say, as long as junk bonds are happy, then gold can still go up and all these things can go up, and they are, but that doesn't mean that the equities are going to depart. So keep your eye on those junk bonds. HYG went right up to the 200 yesterday. It may go through it and fail again, or it may go through it and hold, in which case maybe 4,100, 4,200 is not so crazy in the SPY before we reevaluate.
You think this run into bonds is maybe indicative that maybe we're getting close to the end of the rate hike cycle, and investors are trying to lock in these higher yields all of a sudden, saying that, because I'm torn, because I think it could be a bad year for equities and a good year for bonds, because you start looking and you think, wow, some of these yields have come up to yields we haven't seen in a very long time. And, if you can lock in these long-term yields here, maybe if we just get, even if it's, I don't think we're going to get a soft landing, but let's just say it's a shallow recession, bonds could still win here in that environment. Don't you think, Mish?
Absolutely, Dennis. That's a great observation. And I think that is exactly what's going on. But the notion that we're getting to the end of the rate hike cycle is exactly what scares me the most. Because you can't get to 7, 8, 9%, 10% in some places in the world inflation and expect it to resolve in 6 months. Yeah. Statistically, it could take years. Some people are saying 6 to 10 years based on the numbers. And again, we know the numbers have been not only stretched and changed, but also just in terms of how fast things happen. We're in warp speed on everything. But getting back to your point, I think that's exactly what's happening, that bond traders are locking in at these high yields, and it could ultimately continue to be good for bonds. But if yields go down, then I'm really looking at, I really want to focus on where I want to focus this year and not worry so much about some of these equities that people are playing in and looking for, new highs. I don't see we're going to see new highs in Microsoft and Amazon and Apple and all the growth stocks. And I don't even care. I hope they do, for people's sake, for my own portfolio and for what our quants are telling us. Stick to commodities energy, some pharmaceuticals are good. Interestingly enough, some streaming stocks we've got in there. Our blend bought Moderna recently. I've been long Teva in the discretionary account. Like, I really want to stick more to a theme. And I think that people get into this idea, oh my God, if I'm not trading 25, 30, 35 stocks, I'm missing out. Hopefully you learned about FOMO in the last couple of years and just, have a plan. And that's kind of what I tried to put forth in this outlook.
Who is going to behave the best in the modern family and who's going to behave the worst? And then talk about the adolescent, and then we'll let you go.
Who might not be there anymore, right?
Well, the modern family is so interesting because it's almost like you have a universe in two time frames. On the daily, the Russells cleared the 50. It looks like the transportation cleared the 50. Retail is looking better. But on terms of, if you just look at the weekly charts, biotech definitely looks the best because biotech is trading above the 50 and the 200-week moving average. It's the only one. The next one after that would be probably transportation, although we'll see what happens today given the story, the headline story this morning. But transportation is important because that's going to help determine how much things move in this country and what supply chain and trucking really looks like. That's the second best right now. We have to keep an eye on it. And if and granny retail is trying to get back over the 200-week, the Russells are right there. I mean, they're all right there. They have such strong headwinds. The one that looks the worst is actually, to me, the regional banking, our prodigal son, which go back to your theory, Dennis, on the rates. If the yield, if people are trying to lock in high yields and they're not going to necessarily borrow money at these levels, but lock in their CDs and things like that, then it's possible what we're really seeing is the stress of the banking system more rurally, in spite of the fact that you have a JP Morgan doing really, really well. And that measures the pulse. I'm keeping a close eye on KRE for the next few weeks.
Okay, Mish Schneider, Market Gauge, giving us her 2023 outlook, covering a lot of stocks and a lot of sectors. It's great to hear your cheery voice and optimism and also some pessimism here. That's what the market's about. We'll get you on again real soon, Mish. Thanks for joining us.
Thank you, guys. Thank you, Joel.
Definitely. That was a good interview.
Lots to think about, for sure.
I have to say, top interview of the week. Other guests, I'm sorry, but top interview of the week so far. But let's get back to the market. How